Hi, I'm JB. In this video, we're going to take a look at the Chinese market and determine if we really want to put our hard-earned dollars in this strange market. There has been a lot of different takes on the Chinese stock market and the recent crackdowns from the CCP, but here I will give my perspective on the matter and what I'm doing in this situation. I am not going to spend a lot of time explaining the VIE structure or the ADR. I'll leave a link below to an explanation from Investopedia, which I find pretty good. And then I'm going to let Chamath Palihapitiya does his short explanation, which I actually find very, very funny. So let's get into this. How does the Chinese market actually work for foreign investors? A little bit on the VIE, the ADR, and how you could buy through the Hong Kong exchange. And then I'm going to look a little bit into why the CCP is doing this. There are some background reasoning and maybe some reasons we don't really actually know. Then I'm going to take a look at what does the smart money do? How could we do it? And what should we do? I mean, this is not financial advice. It's just me sharing my thoughts. In the conclusion, I'm going to tell you what I'm doing. As I said, here is Chamath Palihapitiya explaining what an VIE structure is and how it works. And I'm sorry for the length of the clip, but it's a fantastic clip from the All In podcast. Did I mention this is the best podcast? You really have to go look it up. It's on YouTube, it's all the different places. The All In podcast. I'm leaving a link at the bottom. This is a must-have for any investor. So, short, VIE.
What is a VIE? Because you're going to hear this a lot. A VIE is what's called a variable interest entity. And what it is just a massive workaround. So essentially what happened was a VIE was a legal business where, an entity had control of a company, okay, through a contract, but not through equity. So it's kind of like, Saks, like I had a contract with Colin that said I can dictate, who does what, etc., but I don't own any equity. Now, the company that completely ran afoul of all of these things was Enron. And back in 2001, Enron went fucking ham, as we all know. They had a bunch of these VIEs, and they used it to basically shield a bunch of losses and do a bunch of shady things. So then there was a bunch of accounting laws that were introduced. China, on a completely separate track around that same time, was like, hey, listen, we want to control our economy, so we're going to prohibit foreign ownership. So just for all you guys to know, China to this day does not allow a foreigner to own a piece, large sections of the Chinese economy. And so because of all these restrictions, the Chinese internet companies were like, hey, hold on a second. I need to get access to the capital markets. What do? They dusted off the VIE structure and they basically created all of these, Caymans, holding companies. And that's where all the American investors would go and buy equity from or contribute equity to. And so, Tencent, Alibaba, Baidu, Didi.com, JD, all of these folks have these VIEs. And what's interesting about these VIEs is it's written clear as day, but not a single investor seemed to care. But in the prospectuses of these Chinese companies, they were clear. It doesn't mean you actually have a claim on the assets. It doesn't mean you can actually make a demand of management. I mean, if you saw this in an American prospectus, you would not put a single dollar into these companies, but in fact, the exact opposite happened because people were greedy and chasing the money. And these risks, by the way, came back to bear because Jason, I think you were the one that gave the example of the Chinese tutoring guys where, overnight this guy lost 99% of his net worth. I think this was 1 or 2 pods ago. The way they did that was that they canceled the VIEs. They said online tutoring, nope, sorry, these things can't exist anymore. And so essentially, we have the situation now where VIEs are part of 58 companies, massive Chinese mega cap companies that are in the huge indexes in the United States. These 58 companies account for $2 trillion of market cap.
And the next clip, Chamath is going to say exactly why I am not investing in China.
Because when they canceled the online tutoring VIEs, the stock prices basically went to zero. So you could eviscerate $2 trillion of market cap tomorrow if they decide, you know what, that VIE for Alibaba, by the way, Nick, I'll send it to you, but it's a thing of art. If you look at the VIE structure for Baba, I mean, it is a fucking babushka doll of nesting entities and this or that. I don't know how any investor who bought shares in Alibaba actually took the time to understand what they were actually buying.
They suspended disbelief because they were greedy.
So the point is that's happening. Okay, so the capital markets are now, I think, getting really constrained. The complement to this is that they're starting to now introduce legislation as a prelude, in my opinion, to canceling some of these VIEs in the most important area that we care about, which is tech. So
the CCP does not allow VIE, it only tolerates it for now, and this could easily change in the future. Actually, the same goes for the US. The only thing the VIE in the US is existing is because of strong lobbying from the banks. Do I think China will snap its fingers and void the VIE? No, I don't think so. China needs the capital coming this way, and the risk is around the same as if US would do this. If they were to do it, it would give a lot of problems with countries that are invested in China. But we have to remember, it happened before, and when China suddenly determines that a company has fallen out of grace, they can stop it immediately. And even if they don't delist or do anything like that, your share price will still drop to almost nothing. Trading through Hong Kong Stock Exchange. Well, actually this is also done via a VIE. Here you just own the actual Cayman Island company representing the Chinese stock. Is it safer? I don't know. I don't think so. Because you have the same inherent problems. Buying the stock in Hong Kong Stock Exchange doesn't remove the VIE delisting risk, as the stock still is using the VIE. Only the ADR delisting risk is negated, so I don't see it why. So what does this mean? Should we invest in China? Maybe. Should we not? Maybe. This is all determined what your strategy is, what your risk level is, and how you perceive the growth in China. Now, why is China cracking down on the tech companies and the education companies and some of the gaming companies too? Well, the official story is that we want to secure a high level of regulatory compliance. We are working towards the highest degree of user protection. Yeah. I mean, I think it's part of the reasoning, but not the complete picture. This is about control. This is about how you keep your people in line. And hey, it worked. Most of the companies, just look at them, Alibaba and others. Most of these companies got the message and have since pledged a lot of money to the so-called Chinese cause and educating the Chinese people. Yeah. Alibaba, for instance, said that they will freely pay to make China a better society, and all the other blah, 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 blah that you have to write in your communications to look as if you really care. Basically, it's just a way to influence the politicians and the people in power so that they can leave them a little bit alone and do their thing. What does the smart money do? Well, most of them buy the sectors that are not yet targeted, and if they don't do that, then they go for the stocks that have been hit the hardest, and this way they get in at a low price. So even if in 2, 3, 5 years' time something happens, they will still have made a higher gain than the rest of us. Some of those big investors realize that if they are greedy when others are fearful, they can secure a larger gain, and this way ensuring that they won't lose money if something happens later on. You also have to keep in mind that many of these big investors, they have a lot higher risk tolerance and will accept the loss that you and I may not be prepared to. The real smart ones have accepted to invest in China, but only in the companies with a low risk and therefore by design not getting the higher return, but a lower risk. Well, what should we do? Well, it's all up to you, your risk-reward strategy, how you're going to do it. Personally, I would like to invest in Tencent and Alibaba, but I also realize that the risk is too high for me. So if I were to do it, I would limit it to around 5, max 10% of my portfolio, and I would probably have a lower time horizon than other people. My time horizon would be about 2, 3, maybe 5 years. When dealing with China, you have a lot of different factors determining if you should invest or not. And as the great investor Peter Lynch once said, the sucker going down is not a reason. It can actually go to zero. Look how the big investors do. I mean, Berkshire Hathaway bought airlines back in 2016, and they dumped them like a stone in 2020 and took a massive loss. These big funds, they can take this loss. You and I, we can't. One of the reasons I actually don't invest in China is that I'm satisfied with the returns I get on my other stocks. And I mean, honestly, isn't the risk too high for the gains? I mean, looking at Alibaba, for instance, they haven't been growing that well. I mean, maybe Alibaba is going to have a long, great run and be kind of like the Amazon. But I don't think so. I mean, I really don't think so. I think they're going to be reined in again and again and again. So those gains that I could get by investing in Alibaba, I can get elsewhere. It's like I always say to the people who say, oh, we're going to look for the new Tesla. Well, Tesla is the new Tesla. There's a big difference when being greedy and being thoughtful, that you really have to understand what you invest in. And finally, for the end of this video, I would give a short comment to Jason Calacanis from the All In podcast, and he sums it up very well. The All In podcast is a must. You need to listen to that podcast. It is the best podcast I have ever listened to. These guys are just perfect, and you get a lot of good ideas listening to them.
Always remember, China is a communist authoritarian country. Sometimes we forget that here in the West because we have been in this, really deep integration with them around the world. And we're building iPads and phones over there. They're taking our movies in the NBA. They bring us Amazon Basics cables. But we're in partnership with a communist, authoritarian, human rights violating regime. Keep that in mind, because we've all been living in a mirage that China is heading towards democracy. They are not.
And thank you for watching this video all the way to the end. And if I could trouble you with hitting the like button, or maybe even subscribe, it would make me so happy. And I really mean that. See you in the next one.